Good evening and thanks so much for tuning in. This is the ET Money Show on ET Now and my name is Alex Matthew. Now this show gets you everything that you need to know when it comes to your money, how to earn more of it, how to invest it wisely and achieve all your financial goals, and also how to spend, because that's a very important aspect of the management of money, and you need to earn or enjoy the fruits of the labor that you have put in to earn that money. But today we're going to be talking about a very important cornerstone of most people's finances, and this has to do with life insurance. When do you need it? How much do you need? What do you need to know about the premium? We'll talk about all of that and more with my guest for today. He's Dheeraj Sehgal, Chief Distribution Officer Institutional at Bajaj Allianz Life. Thank you so much, Dheeraj, for taking the time. Let me start with the most basic question, which is, I think a lot of people perceive this as an overly complicated process. How easy or difficult is it for an individual to go out and get a life insurance policy? And here I'm talking about a term policy.
Sure. First of all, Alex, thank you so much for having me over for this show. It indeed is a very, very important topic that you are discussing today. Buying a term insurance plan is actually very simple. What we only need to do is reach out to one of the touch points of the life insurance company. Could be a bank partner, an agent, or a website, or any other partner that we work with in the industry. You just need your KYC document and some income proof documents, and you can buy the term insurance plan. The premium depends on the age at which you're buying, your health condition, and depending on your age and health condition, at times the customers might be asked to undergo some medicals, and you're good to go. You can buy a term plan like that.
Okay, but I want to get into some of the more specific details when it comes to what you just mentioned in terms of the KYC, in terms of the medical health card. What are the various factors that would determine? You mentioned age as well. So can you give us a sense as to how the premium changes? May not necessarily get into the actuarial calculation of it, but for a lay person, how do you describe how the premium is calculated and how it goes up basis certain changes in metrics, age, for example?
All right. So, see, term insurance is basically we are underwriting risk, okay, risk against the life of an individual, and hence age becomes the most critical parameter. Earlier the better, younger the better. So, people who buy it young will have to pay lesser amount of premium. That's one. Second is the amount of cover that you want to take. The lesser the amount of cover needed, the requirements in terms of going through medical screenings would be relatively lesser. Third thing is your present health condition. If somebody is healthy, fit and fine, then the medical test requirement would not be very high. In fact, these days, the basic health checkup can be done through a telephonic or a video medical interview as well. Some of the people who are carrying health conditions or some pre-existing health conditions might need to go through medical checkups as well. So these are the prominent factors. Another prominent factor is what is the policy term? For how many years do you want to be covered? Longer the policy term, higher is the risk for the insurance company underwriters. So they will ask for more screening. And as I said earlier, it is ideal to go for a term cover as early in life as you can. Of course, you can enhance the cover during the course of your life as the responsibilities increase.
Okay, you've actually summed it up very well. But Dheeraj, in the current context, you mentioned that some of these medical checkups or questionnaires can be done remotely, and this is obviously the insurance industry moving in tandem with what's happening around us, right? Are there challenges that you're facing as an industry, and what does an individual need to bear in mind so that there isn't a mismatch down the line? Because these things, if you miss one thing, then that can prove to be a problem later, right?
Absolutely. So first and foremost thing which people need to keep in mind is that it's a contract between a life insurance company and the individual. So people should be candid and transparent about their present health conditions. Don't try to hide anything if there's a health condition that you're carrying. Second thing is that at the time of buying the policy, you should be very clear about the amount of cover that you are looking for and how many years do you want to pay your premium. That plays a very significant role so that you do not end up getting a suboptimal cover for yourself, because it's at end of the day it is a death cover which is supposed to replace the financial loss which a family has to go through in case the bread earner of the family passes away. So you need to be very careful about the amount of cover that you're taking. And last thing is, for how many years do you need to take this policy for, so that there is sufficient cover for you for income replacement. These are the prominent things that I would say: health, amount of cover, and duration of the cover.
And from the perspective of a service provider as well, Dheeraj, the claim settlement ratio is also something to bear in mind?
I think in broadly, if I speak out our industry, the claim settlement ratio has been quite good. Even during the recent pandemic period, if you see, claim settlement, for example, has been hovering anywhere between 98 to 99.5% for various companies. You should bear that in mind for sure. Look at the data, look at the stats which the company has to offer. But I'm very confident that if you are sharing the right information at the time of buying the policy, claim settlement should not be a worry.
Absolutely. I want to talk a little bit more about the quantum of cover and a certain flexibility in terms of payment of premium. But Dheeraj, I do have to slip into a short break. Please do stay with us. We'll be back in just a bit. Viewers, do stay tuned. Welcome back. You're watching the ET Money Show, and we're talking about life insurance policies, and specifically we're focusing on term policies. We're in conversation with Dheeraj Sehgal, who is the Chief Distribution Officer Institutional at Bajaj Allianz Life. And Dheeraj, we've already covered several aspects of this, but I want to talk about a few important points when somebody is going out for the first time. One of the key aspects to identify is, like you mentioned, the quantum of the cover and also the duration for which you want that cover. So how would you identify what you need? Is there a formula that one can refer to?
So Alex, there are a lot of rules of thumbs that we follow or the market recommends. From my experience, what I can say is that the amount of cover depends on a few factors. First is what are the liabilities that you're carrying? What is the cost of future life goals or future aspirations that you have for your family? Because at times what happens is that we buy the cover considering our present income and present spends. What we need to consider is that what is going to be the future value of the life goal or future value of financial subsistence which my family would need in case I'm not there. So to summarize, it is age at which you're buying, the liabilities that you're carrying presently, and what is going to be the cost or the price of the future life goals, aspirations that you want to fulfill for your family. These are the factors which really matter when you're trying to decide on the amount of cover that you need. However, going by a simple rule of thumbs, people say that 10 to 15 times the present value of my annual income is the ideal cover to take.
But Dheeraj, there is such a thing as taking too much cover, right? It may be a bit of a morbid thought, but somebody once said that I remember, it shouldn't be more advantageous for somebody that you're not there. So how much is too much?
It should not be an advantage when the person is not there. You're right. How much is too much? Again, I would still say the same thing, Alex. It depends on what is the financial subsistence that you would want your family to have in case you're not there. See, emotional losses cannot be replaced. What term cover will take care of is the financial loss. So you need to decide today what is that life cover, what is the expense that your family would need in case you're not around, and just cover for that amount along with whatever life goals you have for your spouse, for your kids, uh, and for how long do you want to provide that subsistence. Those are the things which should be considered. As far as how much is too much, I think you should start with what does it look like today, and as your responsibilities increase, as your cost of living increases, as your lifestyle goes through a change, you can always continue to enhance your cover during the course of your life as well. It's not that what you're buying today is the only one that you can do. It's always possible for you to enhance the cover subsequently.
True. All right. Just like any other, part of your portfolio, you need to review this on an ongoing basis. Just wanted to understand in terms of whether there is a flexibility in the premium that you pay. Can you, for example, increase the frequency or increase the amount of premium that you pay and cover it in a shorter period of time?
Yeah. So when I decide to buy a protection plan or term plan, there are three broad categories of premium paying options. One is single pay. I pay a large sum of amount today, which covers me for the coming few years. Then I don't have to pay my annual premium subsequently. This is for people who probably say that I'm not too sure of certainty of my income in the years to come. And hence I would like to make this one critical decision with the amount of money that I have today. Then the second is you pay for limited number of years. You can choose a 5 years premium paying term. Again, for the people who say that, I have a visibility of next 5 years, I can continue to pay, but I want the cover to continue for next 20 years or so. And the third one is a regular premium paying term where you say that, I want to cover myself for 30 years and I will continue to pay the premium for all those 30 years. These are the three broad categories of premium paying options. Within this, not in the single pay, but in the regular pay or the limited pay variant, you have the option of paying your premium on a monthly basis, quarterly basis, half yearly basis, or annual basis.
Okay. I do want to ask one last question in terms of the nominee, right? There are a lot of factors that you need to bear in mind to ensure that the person that you're nominating gets the money when they need it most. So what are the key aspects to bear in mind, Dheeraj, so that that can happen, so that you can ensure that that happens?
Very, very important point. Nominee should be a blood. Nominee should be a blood relation, because what happens is that
Okay. I believe that we're having a bit of an issue with Dheeraj's audio. Let me check one last time if I can get in touch with him. Dheeraj, can you hear me? If you can you start from the beginning of that answer that you were just giving us?
That nominee is a very, very important element of the protection plan. It should essentially be a blood relation. It could be a spouse for a married person, or for a person who's not married, it could be parents. What happens is, at times we nominate people who are not in our blood relation, and that's where the insurance companies, they have to investigate to see what was the motivation to select a person who was not in blood relation, who will have a direct impact of loss of this person. So nominee, I would recommend, should be a blood relation and should be very carefully selected.
Okay. Thanks so much for joining in and for clarifying so many things when it comes to life insurance. I think the most important point, of course, is that it is not hard to do, and that it is something that everybody must consider if they have financial dependence. Thank you so much, Dheeraj, for taking the time.
Thank you.